Hey, good afternoon. Accounting 230. Let's get right into it. The subject is statements of cash flows. And this is an important financial statement companies prepare in addition to the income statement, equity statement, and balance sheet. It tells a company where their money has been spent, how they're bringing their money in, and where the money is going. So let's get into this with a shared screen. And we're in chapter 12, statement of cash flows. And let me get this thing set up properly for me. It's all about me. Okay, statement of cash flows. Learning objectives, we're going to learn about cash flows. The purpose of the statement of cash flows. It shows how does a company receive its cash? Why do income and cash flows differ? How does a company receive its cash? Why do income and cash flows differ? Hi, Brendan.
Hi, how are you?
Hey, came in at a good time. We're just starting, okay?
Sweet.
Here we go. Statement of cash flows. And we were just saying the purpose of the cash flow, how a company receives its money. Why does net income differ from cash flows? And we talk a little bit about that. What explains the change in cash balance? And where does the company spend its cash? And there's some rules to follow. And let's get going with a couple of things here. Cash flows help users decide if a company has cash to pay its debts. The cash flow statement, because it breaks out non-operating spending. Users evaluate the company's ability to pursue unexpected opportunities. Managers can plan day-to-day activities, make some decisions, and managers can make some long-term decisions by looking at the cash flow statement. Measurement of cash flows, cash equivalents. What is cash? Cash is money, coins. We know that. Checks, direct deposits, credit cards, automatic deposits. Cash equivalents, short-term, highly liquid investments, typically 3 months. If you have a 3-month certificate of deposit, that's considered cash. Cash equivalents are readily convertible into cash and close to maturity value so that the market value is not going to get impacted by interest rate changes. Objective 1. Now let's understand, distinguish between operating, investing, and financing activities. And then we're going to talk about non-cash items and financing activities are disclosed. So let's take a peek at this. We learned a little bit about this in an earlier chapter. Statement of cash flows is broken out into 3 sections: operating, investing, financing. Operating is where you want to show positive cash flows because operating is just that. It's a measurement of what the business is in business to do. Operating activities for Coca-Cola, bottling and selling soda. Coca-Cola might invest in another company. That would be an example. They bought stock in Microsoft, or they issued a bond, they invested in another company, or more typically, they bought a big piece of equipment like a machine or a car. That would be an investing activity. Financing is money raising, typically borrowing or a stock issue. Operating activities, cash inflows. It comes from customers. It comes from customers. Oh, sorry. It comes from customers. Collect on credit sales from receipt of interest revenue, dividend revenue, cash inflows that are operating. What are operating outflows? Anything that pays operating expenses, salaries and wages, taxes perhaps, rent, insurance, things like that, the normal activities of a business. If a business didn't borrow and a business had no investments, this would be what the business does. Operating is the normal course of events of the business and the resulting cash flow. Investing From cash outflows, you perhaps, I'm sorry, Brendan, cash outflows, you bought plant assets, you bought a building, you bought a giant truck. That's considered investing cash flow. You bought a patent, intangible assets. Cash outflows, you maybe loan money for notes receivable. And what are the cash inflows from investing? Well, you sold your investment, you sold the plant asset. Eventually, you sell your long-term investments. Let's look at financing. Financing is borrowing. It's raising money. We get cash from issuing stock to the public. We can raise cash by issuing debt in terms of a bond issue. We can reissue treasury stock or come up with more money from the ownership. Cash inflows, financing. What are the cash outflows? Well, we bought treasury stock. We paid dividends to our shareholders. The owner withdrew money, or we paid off some long-term debt, some notes payable. That is financing. So keep in mind, we got operating, investing, financing. Those are the three blocks of the cash flow statement. Now you have non-cash activity, non-cash investing and activity. And we have quite a lot of that. Maybe we retired debt by issuing stock. We had some convertible stock. We changed our preferred stock, we moved to common stock. We leased some assets in a capital lease transaction, purchase of long-term assets by issuing a note, exchange of non-cash items, purchase of non-cash. Yeah, these are all non-cash items, but I want to talk also about depreciation and amortization. Those are non-cash on the operating side. Let's take a look at the statement of cash flows, huh? Well, this is what it looks like in summary form, huh? You're going to come up with the cash flows from operating activities and get a subtotal. That total is going to be called net cash provided or used. If the cash flow was positive, meaning you had more inflows, it's positive, provided. You're going to have a subcategory, subtotal for cash flows from investing, and then from financing. The total of those three is going to equal the beginning cash balance minus the ending cash balance, okay? What the cash flow statement is all about is we had $1 million in cash at the beginning of the period. Now we have $700,000 in cash. What happened to that $300,000? The cash flow statement will tell us in excruciating detail. Preparing the statement of cash flows. The statement of cash flows can look a little intimidating at first, but again, we're going to divide and conquer, Brendan. We're going to first do the operating piece, then the investing piece, and then the financing piece. Prepare the statement of cash flows. Compute the net increase or decrease in cash. That's your starting point. That's the figure that you lock in and has to be the total of the cash flows, the change in cash. Come up with the net cash for operating activities, net cash from investing, net cash for financing. Compute net cash from all three of these sources to get the ending cash. Analyzing the cash account, huh? The cash account is a natural place to look for information about cash flows, huh? Who knew? A second approach to preparing the statements of cash flows is analyzing non-cash accounts. Non-cash accounts. And I want to bring our attention to depreciation and amortization. Expenses that have nothing to do with cash, no cash involvement. What do we need to prepare the cash flow statement? We just need a couple of things. We need two balance sheets. We need two balance sheets for the current year and the prior year. We need an income statement for the current year And when it comes to investing section and the financing section, we need additional information that we have to dig out of the general ledger. Cash flows, indirect and direct method. We are teaching the indirect method. The direct method is not GAAP. The indirect method is the way to go, okay? Computing cash flows from operating activities using the indirect method. Wow, look at this, huh? They're giving us two statements here, huh? They're giving us the income statement for the year, and they're giving us two balance sheets to compare. Okay? Those are the source materials we need. Notice on the balance sheet, they're showing you the difference between each year and indicating whether it was an increase or a decrease. For example, cash went up $5,000. Accounts receivable went from 40 to 60. That's an increase. They're all increases, it looks like. They're showing increases down here too. Accounts payable, they're showing decreases. We have to get familiar with the rules of those increases and decreases, which we're going to go over in a slide or two. And then they're giving us some other information. They're giving us the accounts payable balance results from inventory operations. Okay. They're showing you that they purchased 60,000 in plant assets. They sold plant assets. Accumulated depreciation was this. They got involved with some treasury stock. They received, they bought some treasury stock, or they issued stock to the public. They paid off a note and declared dividends. Each one of these things has to be addressed on the cash flow statement. Applying the indirect method, okay? Here is the first section of the cash flow statement. And this is the little bit harder one, Brenda, because you have to understand a few rules. The template is right in front of us. We start with the net income. Net income. Now, we have to adjust that net income into cash. Net income was $38,000. Notice that the next couple of lines show depreciation expense, loss on a sale of fixed assets, and a gain on retirement of notes. We have to take the net income and add to it the depreciation expense. Why do we do that? Because the net income was done on an accrual basis. As you know, everything we do is on an accrual basis, which means there are some non-cash expenses there. By adding the depreciation back, we're coming up with a cash basis net income, if you will. So 38,000 plus 24, that would be what, 62,000. There's also a couple rules about the loss on a sale of plant asset or a gain on a retirement of notes. A loss has to be added in and a gain has to be subtracted. This is a lot to absorb in just this slide here. And we're going to go over this in more detail, make it clearer. Here's the real guts of the operating section. They are saying that there was an increase in accounts receivable, an increase in inventory, and an increase in prepaid expenses. If there is an increase in a current asset, that is a negative cash flow activity. Let me repeat that. If there is an increase in a current asset, that is an unfavorable cash flow activity. Let me use accounts receivable as what I think will be a clear example. What increases accounts receivable? Sales made on credit. You've given your product away in the hope of getting paid in the future. So if accounts receivable goes up, that's a negative cash flow. You've given away your product. When you get paid, that's when accounts receivable goes down. That's why a decrease in a current asset is a positive cash flow. Accounts receivables go down only when the customer pays you. The inventory goes down only when you sold the product, and ditto with the prepaid expenses. So that's the key rule to understand, Brendan. Operating current assets, the difference between the two is either going to be favorable or unfavorable. Or a better way to say it, I guess, is inflow or outflow of cash. If a current asset goes up, that's an unfavorable cash outflow, okay? When it comes to current liabilities, you don't have to worry about that. Liabilities, you just follow the trail. In other words, if accounts payable goes down, that is an unfavorable cash flow. If accounts payable goes down, if any kind of payable goes down, that is an unfavorable cash flow. Why? What reduces accounts payable? A payment. Cash comes out, goes out. So if the accounts payable is decreased, that's a bad thing, cash flow wise, okay? We love to see accounts payable pile up. If vendors let us pay it later, that would be a favorable cash flow. So our little template here to divide and conquer a little more, net income plus non-cash expenses like depreciation and amortization and maybe depletion. And then there's a rule on the sale of plant assets and the gain on sale of plant assets, let's say, or in this case, retirement of notes. The reason we have to add back a loss on a sale of plant assets is because that loss has been recorded as part of the $38,000 in net income here. That loss has already been recorded, so we have to move it into the operating section to straighten out the net income. Adjustments for items not affecting cash. And here we go. Here's the beginning of your template again. We start with the net income of $38,000 and we add depreciation expense. We have a loss on a sale of plant assets that has to be added in, and any gains on sales of plant assets or other comes out with a negative. Brendan, this is a real stupid question, and forgive me. You see the slides, right?
Yeah, I see the slides.
You do, okay. I was starting to sweat that a little bit. Adjustments for changes in current liabilities and assets. Here, you can study it right from this slide here. Current assets, if it increases, you subtract it. That's a negative cash flow. If a current asset goes down, you add it to the net income, and it's the opposite with the liabilities. If a payable goes up, that's good. That's good because we got product in here. We got some stuff to work with. We don't have to pay for it, at least not yet. So use this table when adjusting net income to operating. Adjustments for changes in current assets. Well, been over this a little bit already, huh? Decreases in current assets are added to net income. Increases are subtracted. Increases in current liabilities are just that. They're increases. They are pluses, positive cash flow. Decrease in current liabilities, that's a cash outflow. Okay. And here, let me just move this out of my way. And here they're showing you a bit of the presentation. Okay. Come on. Summary of adjustments with the indirect method. Common adjustments to net income when computing net cash provided by operating, okay? And they're just giving you a visual here to perhaps study from net income plus depreciation, plus or minus any other gains or losses. And by the way, you're not going to have to hunt for those other gains or losses. They're simply going to tell you what they are. Your job is to make sure you know how to put them into the cash flow statement. Adjustments for changes in current assets and liabilities, the decreases and the increases we just went over. So you have a pretty good sheet to study from here. This is helpful. So is this. Okay, that's operating. Let's talk about investing in financing, which I think is easier than the operating, because you don't have to worry about any of these. If it went up, what's the impact? If it went down, what do we do? Here, we're going to pick the bones. They are going to give you information that's in your general ledger, and you're going to have to dig it out in some kind of detail. But it's really just kind of a copying job, huh? Cash flows from investing. Find the changes in the investing related accounts. For example, you might have capital stock account, and you've got a change of $100,000, Brendan. You just don't bring that $100,000 over though, because that $100,000 say increase could be because you sold more stock than you bought. You might have had a $300,000 cash inflow and say a $200,000 cash outflow. You have to show the cash inflow as a line item and the cash outflow as a line item. So they're suggesting you identify the changes in the investing related accounts, and they're suggesting you put them in T accounts and reconstruct. You're not going to have to do that. You're going to look at the general ledger. They're going to give you this information and report the impact on the cash flows. Cash flows from investing. Take a look at the plant assets, huh? That is not a current asset. It's not a current asset. What we see here is that plant assets have increased by $40,000 as accumulated depreciation has gone up. Well, the difference of 40,000, we're not going to report the 40,000 number. We're going to have to report a line that says we had an increase in cash of so much money and a decrease in so much money. They have to give you the detail of that 40,000. And I guess this is it here, but they're not very clear. What they're saying here, Brendan, is the $250,000 that represents a sale of stock. We sold some stock back to the public, okay? The 210 represents stock that we purchased in another company. So you're going to show the input, the inflow, and the outflow, and you have a 12,000 increase in accumulated depreciation. Cash flows from investing, second step. Genesis purchased plant assets of 60,000. They issued notes, huh? So that's pretty easy. Debit machinery and credit notes payable. And then item C says that Genesis also, I guess, sold plant assets costing 20,000 with 12,000 of accumulated depreciation. They sold them for 2,000 cash. That's a $6,000 loss. That loss, Brendan, goes right down to your net income. But it's not part of operating net income. Thus, that loss needs to be added up back in the operating section right below your depreciation. So we have a loss here of 6,000, it looks like. And we also reconstruct the entry for depreciation expense, debit depreciation expense, credit, accumulated depreciation. So they're breaking them out in T accounts, your general ledger, huh? So we have under plant assets, we have a sale of 20. but we have an outflow of 60, net 40 there. Your plan asset went up with the 60,000, and there's, oops, sale there. Accumulated depreciation, that's where you're going to dig out the depreciation expense. Cash flows from investing. Cash received from the sale of fixed assets. They gave us that over here, I do believe. Right here, sale of fixed assets. Just hang in there with me a second, Brendan. Here we go. Got a little trigger happy. The $60,000 purchase in item B. We paid down an note payable for non-cash investing. That becomes a cash outflow. Let's get into financing. Financing is simply borrowing or raising money with a stock issue. That's pretty much what it is, okay? We go to the financing related accounts. What are those? Well, I guess notes payable would be one, huh? Treasury stock might be one. Bonds payable. And again, they're suggesting to the accounts and reconstruct the entries because you need the detail and report the cash flow effects. Cash flow from financing, huh? Well, let's see what we have here. The only one that I see, and they're highlighting it in red, long-term notes payable, okay? That's clearly financing. And the note payable went up $90,000, huh? That's probably not good cash flow-wise. So let's see here. It went up $26,000. And they're telling you that that difference of $26,000 consists of a $90,000 activity, less the 64 gives you 26. You're going to have to put them both in here. Cash flows from financing. Here, we're paying down a note. We're paying down the note, $18,000. That's a negative cash flow. We spent the money. That's a negative cash flow. Common stock comes up a lot in cash flow analyses, huh? Here, we're looking at the general ledger, and we see that the common stock went from 80 to 95, okay? And there's not much detail to it. The reason that it went from 80 to 95 is that we sold some common stock here. We issued stock, not sold. Sold's not quite the right word. We issued common stock to the public. That brought in proceeds or cash of $15,000. Positive cash flow. Cash flow from financing retained earnings. We really have to look at the net income, the retained earnings, huh? We're going to see that the retained earnings went from 88 to 112. That's a difference of $24,000. Step 2 explains the change of item F, which reports cash dividends of 14. We debited retained earnings, right? For all dividends, we know we debit retained earnings, and we credited cash. That's a negative cash flow. Here's our net income. We already pulled that out to start the operating section of the cash flow statement. And here is a final cash flow statement, Brendan. And again, it looks a little bit daunting, but again, divide and conquer. Net income plus depreciation expense plus or minus losses and gains on non-operating type activity. Loss on sale of plant assets, that would have to be added back. Gain on a retirement of a newt, that would have to be subtracted, because both of those numbers are already included in the $38,000 net income. By taking these out this way, we're recording the true operating. Changes in accounts in current assets and liabilities, increase, negative, increase, negative, increase, negative. Accounts payable, a decrease. You don't have to worry about increase, decrease. If accounts payable goes down, that's terrible. That's because we paid it. Accounts receivable goes up, that's negative, because we only reduced it. If accounts receivable goes up, it's a negative cash flow because we didn't get any cash at that point. Hey, Brendan, this thing is warning me that we're gonna bomb out in 10 minutes. If we do get kicked out, I'm just gonna go right back in again and continue, okay? So you can join me again, okay?
All right.
Oh, for heaven's sake, come on. And they're just showing you using the T accounts what things look like. The only detail you got to worry about is in the non-operating items, like the long-term note payable, common stock, retained earnings. Apply the statement of cash flows on total assets ratio, huh? What do we have here? Here's a company that had an increase in cash of $15,000, and so did its competitors. BMX, the motorcycle, I guess that is, ATV, and T-Rex. They all have net income from cash increase. So on the surface, that's good. Well, let's look at BMX. Of that 15,000 though, they actually generated 90,000 in operating. They did fantastic, huh? That's good. But you got to remind the boss at the end of the month that we did go out and we bought some plant assets. We bought a big factory for $48 million, right? And we repaid some debt. So even though the cash flow is just 15,000, operationally they're doing great, and that's what you want to see. ATV, they too have 15,000. They didn't pay back any debt, but operationally they're only generating 40 minus 25,000 in an investment somewhere. So ATV is not doing as good. T-Rex had the same 15,000. But look at this. They had negative cash flow that was offset by selling some plant assets, and they had some proceeds from selling some debt from somebody. Again, T-Rex is not in a good position. They're not generating cash from their operation. They're not in business to make money by selling assets or fooling around with debt. That's a bad sign for a possible investor. You'd be inclined to look at BMX more seriously. Cash flow on total assets. This is going to come up later on. Operating cash flow divided by the average total assets. That's all we're talking about. Operating cash flow divided by total assets. It's a real important assessment of how a company is generating cash. If you have $200,000 of cash flows positive operationally, over $1 million, say, of assets, that's a 20% return, which would be pretty darn good. Illustrate the use of a spreadsheet. I am not going to do that. Compute cash flows using the direct method. I am not touching that with a 10-foot pole. Hey, we made it, Brendan. We got to the end of the chapter. Have any questions?
No.
Yeah, this will be a little tricky. I think I laid it out fairly clearly. So just get comfortable with the increase decrease stuff on the current assets, and know that you have to show all the detail on the financing and investing. Okay.
All right. Sweet.
All right, I'll let you go then, Brendan. Nice to have you aboard today.
Yeah. Thank you. Have a good day.
Hey,
Bye-bye.
you too. Bye bye.